The relationship between the British citizen and the state is defined, in large part, by the fiscal obligations set out in the Taxes Management Act 1970 TMA 1970. This piece of primary legislation serves as the constitutional bedrock for all tax administration within the United Kingdom. To understand what happens when one fails to disclose a side hustle, one must first understand the statutory duty to notify. Under Section 7 of the TMA 1970, any individual who is chargeable to income tax or capital gains tax for any year of assessment and who has not received a notice to file a return must give notice to an officer of the board that they are so chargeable. This notice must be given within 6 months from the end of the relevant tax year. This is not an invitation. It is a mandatory legal directive. The side hustle is not a recognized legal category. It is simply trading income or miscellaneous income, and it falls squarely within the ambit of Section 7. The historical evolution of this act demonstrates a move towards strict liability. In the early 20th century, tax authorities relied heavily on manual ledgers and localized knowledge. Today, the legal burden has shifted entirely to the taxpayer. The ignorantia juris non excusat, ignorance of the law is no excuse principle, is applied rigorously by HMRC. If an individual generates income through the provision of services, the sale of goods, or the licensing of intellectual property, and that income exceeds the statutory trading allowance of £1,000, the failure to notify HMRC is a crystallized breach of the law. This breach initiates a tax liability accrual. From the moment the notification deadline passes, the taxpayer enters a state of non-compliance. This is a critical distinction. You are not just late, you are in violation of a primary statute. This violation grants HMRC the immediate legal right to use its inquisitorial powers to investigate your financial affairs, not just for the current year, but potentially spanning decades into the past. In the modern era, the primary risk of non-disclosure is no longer human error. It is algorithmic precision. To understand how HMRC identifies undisclosed side income, we must conduct a deep technical analysis of the Connect system. Connect is a multi-billion-pound data matching and analytical engine that represents the pinnacle of fiscal surveillance technology. Connect does not function as a simple search engine. It is a massive-scale relational database that utilizes social network analysis (SNA) to map the financial reality of every UK resident. It ingests data from over 30 distinct sources, creating a 360-degree profile of the taxpayer. These sources include financial institution feeds. Under the Common Reporting Standard and domestic banking laws, every UK bank and building society provides annual reports on interest earned and, crucially, suspicious transaction patterns. Merchant acquirer data. HMRC receives data from payment processors, Stripe, Square, PayPal. If a personal bank account is receiving a high volume of small-value payments consistent with trading activity, the Connect system flags this as undisclosed commercial activity. Third-party digital platforms. As of January 2024, platforms such as eBay, Vinted, Airbnb, and Etsy are mandated to report user earnings directly to HMRC via the model reporting rules. Governmental cross-referencing. Connect pulls data from the land registry, property ownership, the DVLA vehicle assets, and the council tax records. The Connect system utilizes predictive analytics to identify lifestyle inconsistencies. This is a mathematical calculation where the system determines the minimum income required to maintain the assets, associated with a national insurance number. If a taxpayer has a registered mortgage on a high-value property and maintains multiple luxury vehicles but declares a total income of only £20,000, the Connect risk score rises exponentially. This score determines the priority of a compliance check. In the eyes of the algorithm, silence is not invisibility. Silence is a data point that suggests concealment. When non-disclosure is identified, HMRC applies the penalty framework established in Schedule 41 of the Finance Act 2008. This framework is designed to be punitive, escalating based on the behavioral category of the taxpayer. HMRC calculates penalties as a percentage of the potential lost revenue, PLR, the amount of tax that would have remained unpaid had the non-disclosure not been discovered. There are three primary behavioral categories defined in the legislation. Non-deliberate, careless. This applies if the taxpayer failed to take reasonable care but did not intentionally mislead HMRC. The penalty range is 0% to 30% of the tax due. However, if the disclosure is unprompted, meaning you tell them before they find you, the penalty can be reduced to 0. Deliberate but not concealed. This applies if the taxpayer knew they had an obligation to notify but made no active attempt to hide the income. The penalties here range from 35% to 70% of the PLR. Deliberate and concealed. This is the most severe category, involving active steps to hide the income, for example, using offshore accounts or false invoices. Penalties range from 50% to 100% for domestic income and up to 200% for offshore income. In addition to these percentages, HMRC applies statutory interest under Section 101 of the Finance Act 2009. Interest is calculated daily from the date the tax was originally due. Because an investigation often takes place years after the non-disclosure began, the interest alone can often exceed 20% to 30% of the original tax debt. Consequently, the total financial liability, tax plus penalty plus interest, often results in the taxpayer paying back more than double what they actually earned from their side hustle.